Hello, hi. My name is Jerry Miller from Trendsignal, the trader education company. This is a bit of a review of last week, but a focus on the coming week. Important week for the markets, like they all are actually recently. Non-farm employment change. It's a key data release for the Federal Reserve. They look at that pretty closely, and we got some interesting data on Eurozone inflation, and it just sort of starts to look like inflation is possibly starting to subside without getting too excited about the one swallow that's come along. Or the markets have made the mistake three times already this year in second guessing where inflation's going. But the numbers are starting to look more interesting of late. Anyway, let's have a quick look at the first bit, US employment data. It's one of the Fed's mandates, so it's two mandates, unusual for a central bank. They normally just have one mandate, which is to maintain price stability through monetary policy. But the Federal Reserve, the US central bank, actually has two. One is to maintain price stability, like all the others, but also they have to foster full employment. So they take note of all the employment data, and we've got two readings this week. One is the ADP payroll company that has its own take on employment data, and that comes out on Wednesday. And then we've got the big number on Friday, the non-farm employment change, curiously named NFP for short, non-farm, because what they do in the US, they exclude the farming sector, which is very seasonal in its use of employment, and where there's a staff are taken on and then let go as the seasons progress. So to smooth out the sort of fluctuations in it, they remove the farming sector. So it's called the non-farm employment change. Let's have a quick look at what we're expecting first of all. So I've just opened up a browser window with the Forex Factory's economic calendar. It's quite a useful one because it's simply says the date, the time of the data release, what currency or country it's going to affect, what the impact will be on the market. So they've got a red, amber, and yellow sort of um, impact tag. We're only looking at the high and medium impact ones. We look at the low impact ones. There's just too many bits of data to look at. Anyway, what we're looking at here is the ADP non-farm employment change. That comes out 1:15 on Wednesday. It's a bit of erratic number actually, and over the last sort of year, 18 months, it's become less important, but nevertheless, if it does come out and it's wildly different from what was expected, then it will impact the markets. But otherwise, the market tends to wait until Friday for the main event. But we're looking at a number of around 200,000 new jobs, so that's falling from 239,000 the previous month. And if you want to have a look at the graph, you can see that. Let's just shrink that down a bit. You can see that the employment data is softening a little bit, but it's just very erratic when you see these negative numbers followed by another positive number. And over the last couple of months, 2 or 3 months, they've been ticking up from the previous 2 months. So not a lot we can glean from it. Whereas if we go forward to this Friday, to the non-farm employment change, this is the one that's released by the Bureau of Labour Statistics. That's the official body that produces this data. And they're looking for 200,000 jobs again here, but that's from a reduction of 261,000. And, you know, the jobs market hasn't really seen much movement. I mean, this is the graph of the official statistics. You can see this year, sure, it's come off marginally, but it hasn't really come off anything like enough. I mean, the employment sector is still pretty red hot, really, and it's something that is causing, it's a bit of a conundrum for the Fed, of course, because they can react to prices quite easily. But the trouble is, if there's a particularly strong labour market and average hourly earnings are still quite strong, it basically means it's a quite a strong indicator for future price pressures. So I think the Federal Reserve will be wanting to see this number decrease. So if anything, it's probably even more important at the moment because we've only got this data and then the inflation data next month before the Federal Reserve meet for the final time of the year next month, and that's when they're going to make their decision about interest rates. So this will have a direct impact on exactly what they're considering. At the moment, we know that the Federal Reserve, looking at what the markets are saying, they've softened over the last couple of weeks. Ever since we had that data, the big candle here, this is the release of the inflation data in the US back on the 10th of November, earlier this month. It came on weaker than expected, but we've had months where it's come out weaker than expected, followed by months where then were stronger than expected. So everyone's hopes were dashed. And I think the market is feeling more optimistic, hence the reason why we had this big jump up on the 10th. And the markets, if anything, have just consolidated those gains, which is quite interesting. I just call it optimism, but optimism founded on a few more facts than of late. Okay, let's get back to my presentation. So just back to my PowerPoint. um, the conundrum we've sort of addressed really. The conundrum for the Fed is that with prices falling, um, the market is expecting the pace of rate rises to start to slow. And that's really been reflected in the risk on move that we've seen over the last 2 and a bit weeks, with equity prices flying high, bond yields coming off quite sharply, really have come off sharply, and the dollar um, falling against the euro, falling against sterling. Sterling's had a bit of a star performance over the last week. Well, especially last week, I think it was up about another couple of cents against the dollar and 1 cent against the euro. Really, it's just come from such a low base. The Truss quasi-Quarteng induced swoon in our sterling markets following the announcement of those unfunded tax cuts. But anyway, that's all been reversed, and I think the market's enjoying, a reasonably good run of it just of late. But still, the doom merchants or the gloom merchants from the OECD and the IMF still think the UK economy is going to be hit pretty hard, probably the worst out of the G7 economies. So just to not get too depressed, but that's just the way it is. Um, so um, let's have a look at inflation. So that's unemployment data. The key number really is to look at is for Friday at 1:30. Eurozone inflation. This is something that caught my eye earlier. Um, what we've got on Wednesday this week is the Eurozone inflation, and they release what's called the flash CPI estimates. And I want to sort of look a little more closely at this because commodity prices have been falling. I mean, I track quite a few commodity prices, and I remember when I had some work done in my garden, I was told by the landscape gardener that, oh, you're going to have to pay a lot more money for the wood now. And he gave me a quote last year and then updated it this year, and it was like double. And I followed lumber quite closely, but since since I had my work done, the price of lumber's come off, gosh, 67, 65%, something like that. But it's not just lumber. Let me just I'll just go to a page on the FT and show you what I mean. So this page is from a portfolio I set up just to track a bunch of commodities, and it's on the FT's website that I've subscribed to. And you can see here coffee down. Copper's picked up, but it's still way below where it was. You can see the little graphs here on the right hand side. Corn down, but it has picked up again. Oil, we know all about. We follow that really closely. That's NYMEX crude, but I can tell you the Brent market is exactly the same. And as we speak on Monday morning, on the 28th of November, crude prices are off another $2.50. So the pressure is still mounting further. That lumber market I talked about, you can see here the little graph here showing that lumber right the way down. Soybeans, like with other grains, wheat and soybeans and corn, all a lot lower than where they were at the midsummer when the markets were feeling the full effects of the war in Ukraine and the spiking commodity prices, and also shipping costs. Freight rates were super high. That's all changed. Not just commodity prices, but freight rates have really normalized. To take a container back from Hong Kong to the UK, I know about this because my daughter had to do it to bring all her stuff back. Pre-pandemic, it was around $1,200 a container, went up to $10,000 to ship a container back to the UK. So yeah, it's expensive stuff, but that's sort of normalized now. So that's taking away those price pressures. All of these prices will be adding to that. Will it be reflected immediately in inflation? No, because it takes time for the raw material cost. This is sort of the costs that go into production, certainly in manufacturing, all these raw materials, and they're only reflected in the finished goods months later. So there's that lagged effect. But a lot of economists believe that inflation in the Eurozone, in the UK and Australia will peak probably in Q3 or early Q4. Sorry, Q4 or early Q1 next year, I should say. So we can expect interest rates still to go up in the UK. They will continue to go higher in the Eurozone, but it's likely they're going to peak earlier than economists had expected. And this is all dependent on whether there is another squeeze on energy, if there's a super cold streak in Eurozone, UK weather, winter weather. That could change. It's a little bit uncertain, but the way things are looking now, it looks like a lot of this has shifted um, forward a little bit. So the peak in inflation is going to happen sooner rather than later. There we go. Let me just get back to my presentation just to finish in a second. So yeah, I should have clicked onto that actually, but we've just been looking at that inflation and we know what's happening with commodity prices and we know the effect that it can have on inflation, and that's something that we'll be looking out for. Anyway, that's it. Thanks very much for listening and watching. All the best. Bye now.